Hello, everyone. Thank you for joining our Q1 market call. I am Phillip Nelson, Director of Asset Allocation, and joining me today is Oliver Fadley, who is a senior member of our research team covering private debt. First, just want to hit on a couple, administrative items. We'll have questions. We'll save that to the end of the session. But if you do have questions, please direct them to the question box in the top right of the webinar panel, and we'll look to address as many of those as possible at the end of the prepared comments. We've got a lot of ground to cover, but we're gonna be doing a review of kind of our key market themes, views on portfolio positioning, and then Oliver's gonna have an overview of private debt. But first, I thought it'd be good to kind of just do a quick hit on the markets from the last quarter. And so let's get right into this and be efficient with everyone's time today. But as we look to what happened this last quarter, probably the biggest story is really revolves around interest rates. We saw pretty significant upticks in rates, in Treasury specifically, but also around the globe. And we saw that in terms of the returns we see from most kind of traditional fixed income asset classes. I think kind of the interesting thing, or maybe the optimistic component to that is, equities held up relatively well. Despite what, I think a lot of fears of rising rates, what that would do to equity markets, they seem to weather it, fairly well. And we'll get into some of the details of, the kind of equities and rates and the movements kind of in more detail in some coming slides. But I think first, when we look at the outlook for U.S. economic growth, it really helps to kind of show that the rate movement was relatively rational. We saw a big uptick in growth expectations, especially for 2021, and that is a reflection of both the speed with which the vaccines rolled out in the U.S., but also support we're seeing from the fiscal stimulus measures, especially the recent Stimulus Act passed in January of this year, which really helped to provide some steady tailwinds for growth expectations, and rates rose as a result. And you can really see that here, where especially in the back end of the Treasury curve, we saw rates rise 80 to 90 basis points, which again is a reflection of less economic concern related to kind of future outlook, but also inflation expectations did rise, and this is reflected especially in the back end of the Treasury curve with rates rising. As part of that, we saw a pretty healthy steepening of the Treasury curve. If you think of the kind of classic signal is the yield difference between the 10-year Treasury and the 2-year Treasury curve, Treasury yield, really highlights in some cases, when you look back to history, reflects kind of the environment that you can expect for kind of risk assets. So historically, when the curve inverts, that's typically a fairly negative or foreboding signal for markets. And as the curve steepens out and remains relatively steep, that's usually a pretty positive sentiment for risk assets on a forward-looking basis. That said, when we think about kind of the movement we saw, as mentioned, the back end of the curve rose, but we saw little movement on the front end of the curve, and that's really a reflection of the Fed continuing to kind of pin short rates kind of near zero, and as they've said it, they'll continue with that plan for several years. But we did see kind of a bit of disconnect, coming out of market expectations. What we have here is implied probabilities of a rate hike in 2022. And this data is as of the beginning of April. And we saw over the course of the quarter, pretty significant rise in expectations of a rate hike in 2022, with the market almost expecting kind of near certainty that this will occur. And frankly, this is in contrast to what we've heard from the Fed in their statements, where they've been pretty strident in their view that rates will remain low for the foreseeable future. And I think in some ways this kind of confirms our view that rate expectations maybe have got a little kind of over-eager in terms of the market expecting rates to rise, and some of that might also be a reflection of kind of maybe a misinterpretation of inflation expectations over the next year or two. And I think it's an important segue to think about kind of inflation. Inflation's been, a much larger topic over this last quarter than maybe we've seen in prior years. And really that's a result of, the data points from a year ago at the depth of the pandemic and what we've seen today. But maybe most important is, what is the market telling us? What are investors telling us in terms of inflation expectations? And I think that important piece is, when we look at inflation expectations 1 year from now, and this is the green bar here, you can see the market's expecting a little over 2.5% in terms of where US CPI might be. But if you look 3 years out, the market's expecting inflation to be lower. And if you look 5 years out, lower, 10 years out, lower. So in some ways, there's an inverted curve, you could say, regarding inflation expectations. So really the market's telling us inflation is going to be somewhat transitory and have kind of a short-term pop. And then over time, will normalize to kind of what's been a level that we've seen over the last kind of 10 plus years, and kind of 2 to 2.5 range. And that's something we expect to continue as well. And if you kind of dig into some of the inflation details, when you look at the main components that fuel, or the main components that influence CPI, you can really see that the most recent data print shows how big of energy was a contribution to the recent 1 year CPI print. And if you look back to where we were a year ago, think of headlines of oil turning negative for a short period, gas prices being at kind of cyclical lows, all of these data points associated with really kind of the economic lows of the pandemic. So we wouldn't be surprised if we see, CPI levels above 3, or even kind of in the high 3s over the next couple months. And that's really going to be a function of, the year-over-year comps coming from the energy sector. But we think that'll normalize as we get to the back half of the year. And I think the real, point of piece to really focus on, especially if you have concerns about kind of the inflation outlook for the US, is the services sector. That is the kind of core of the economy. And if we see relatively stable prices coming out of the services sector, which we have seen and we expect to continue, then inflation should be pretty muted. And that's our expectation on a go-forward basis. One thing to mention is, just to kind of tie this up a little bit, is when we think about performance of equity markets over the last quarter, it really reflects some of the trends I was just mentioning. Rising interest rates, benefit the financial sector, especially banks. And obviously the changes in energy prices flow through to, the energy sector here. So we saw, a little bit of a kind of a short-term, value versus growth trade that came through, and also kind of a small cap bias that flowed through in markets. But in some ways, that's a bit of a, recovery bounce as kind of the vaccine rollout improves, and also kind of economic growth, starts to stabilize and kind of reach maybe a new normal as we hopefully get closer to a post-pandemic environment. And as we look overseas, U.S. dollar strength is probably the biggest item that kind of was the headwind to returns. For most part, we saw positive local equity returns across most markets, especially in Europe and Japan. But currency weakness was the offset. And then when we look to China, some idiosyncratic issues there in terms of regulation of tech names was a drawdown. And then Turkey and Brazil, kind of other bigger negatives in the EM sector, really kind of more kind of macroeconomic focused issues that are more specific to each of those countries. So we're going to take kind of a brief segue and just spend a moment to talk about our key market themes. I think for those that have been repeat viewers and listeners to our quarterly outlook, they'll have heard this before, but I think in many ways it's important for us to kind of reiterate our views and thoughts on what are the key themes driving the markets. And as we mentioned before, there's two really dominant themes that we would say are influencing market expectations. One is what we'd call virus trajectory, which really reflects the influence of COVID-19 and the pandemic on the economy and markets, both today but on a go-forward basis. And then permanent interventions, which is had a really significant impact on the markets over the last several years, both in terms of the Fed involvement and also kind of fiscal stimulus. Maybe just take a moment to talk about virus trajectory. This is headlines that I think we've all read and seen, but we're approaching over 50% of adults in the U.S. have received at least one shot for COVID-19 vaccine, which is relative to most of the world, far exceeding the pace that we're seeing, with the exception of maybe kind of Israel and the UK. And so when you think about how this translates to economic activity, the US, may be one of the kind of fastest growers and the quickest to grow out of some of the pandemic lows that we've seen, which is a really important data point as we think about, other areas in the globe, parts of Asia, Europe, that trajectory of economic growth is likely to be slower than we see in the US because of the, maybe longer time it takes to get shots in the arm. I think the other important data point to think about is there's both the short-term economic trajectory that we think about, but also what are the long-lasting macroeconomic impacts that come from everything involving the pandemic? How does the labor market change? How does where and how people work influence both economic results, productivity, but ultimately, capital markets as well? So these are all, to some degree, kind of open questions or unanswered questions, but things that we'll be keeping an eye on, excuse me, over the next several years to kind of understand their impact. And then we think about permanent interventions. As I mentioned, this is a really important theme for us and really reflects this belief that over the coming years you'll see a steady influence and a steady tailwind coming from monetary policy support and also fiscal measures to support the economy and support markets. And we thought it's helpful to, show some of the stats in relation to 2008, 2009, where we saw, in some ways now, kind of the, the test phase for a lot of these measures. And you can see the speed with which, policies have been, deployed in the U.S., far outpaces what we saw in 08 and 09. The monetary policy effect is continuing to grow as the Fed, continues to expand the balance sheet with their purchases of Treasury securities. And then most recently, we saw the American Rescue Plan Act, which totaled almost $2 trillion, pass in January, which added, another, significant component to, stimulus as a percent of GDP in the U.S. And we see similar types of data points outside the U.S., in Europe and in Japan, but I think it's kind of most strident to kind of highlight that here because it really has the opportunity to kind of keep the markets and support sentiment on a several years going forward, and really informs our, some degree, call it bias to believe that kind of risk assets are going to be favored over the next several years. And that takes us to just some brief thoughts on kind of the strategic outlook or our asset allocation outlook. As I mentioned, permanent interventions really reinforces our positive outlook and view of investor sentiment. And that translates into kind of a belief that higher equity targets can be supported on a strategic basis for many investors. Part of that flows through from the expectations of equities relative to cash and rates. That return differential remains relatively wide, even with the return increase in rates we saw this last quarter. So we think having a higher strategic allocation to equities is something to consider. But I think also, thinking about, the other side of the equation of, managing kind of portfolio diversification and downside risk, there's still a wide range of outcomes associated with the pandemic and kind of post-pandemic economic activity. And we think it's important to maintain kind of a, quote, safe haven fixed income allocation. And for some, that might translate to a strategic allocation of treasuries. Others, that might be kind of more corporate securities paired with treasuries in an LDI context. So everyone has kind of their own unique safe haven exposure relative to their tax profile or investment objective. But we do really think it's important to maintain that allocation and at its core, to have that be available as a source of liquidity should we see market stress. That said, we wanted to provide some thoughts just on our current outlook. We saw a fair amount of price adjustments and changes in rates and other areas this last quarter. So we thought it'd be helpful to kind of reemphasize some of our current outlook and thoughts on current positioning. And I think, two items that probably are most important to emphasize is one, kind of in the equity complex, we very much favor US and emerging markets over EFI, or non-US developed areas. And I'd say, some of this is just a reflection that we think, some of the macro sentiment that kind of outlines the US economy favors US equities. And we'll go into a bit of kind of, the rationale for why we still believe in emerging market equities. And I would say we don't have a as positive view of non-US developed equities, but I wouldn't say we have a negative view. So in some ways, if you have two positives and a neutral, the neutral is a bit of the funding source for that positive outlook. And then I think also, it's always important to look to what asset classes had kind of the biggest price action, the most volatility. And we clearly saw that in fixed income this last quarter. And it really encouraged folks to, take a close look and look to rebalance their fixed income exposure, specifically in the safe haven category. And this might be as simple as kind of rebalancing the treasury and tips allocation we hope, most total return investors have, or, thinking in the LDI complex for folks that have a, more of a liability driven investment approach. This might be an opportunity to step up to the next, glide path trigger point, and look to that to, rebalance the both kind of duration profile and, thinking about adding duration with U.S. Treasuries as you, increase your funded status, as we've seen for several pension plans. And maybe kind of an important point to cover also is, as I said, we favor EM equities, and often think it's important to, highlight a few details on that EM view, especially in a quarter where, U.S. equities outperformed EM equities. I think central to our view for the emerging markets is really that, Asia is the core thesis. And what we mean by that is if you look at emerging Asia, and specifically when you think about, China, Taiwan, South Korea, some parts of Southeast Asia, there is what we have identified, I think many others, a growth story around increased consumption from consumers. And you can tie this to urbanization trends that are driving productivity gains and increasing job opportunities as people move into the cities, but also has kind of a longer term benefit that flows through in terms of higher income, higher per capita GDP levels that translates to greater levels of consumption. And clearly, China is the largest economy kind of in that region, and frankly is, the core driver of this thesis. And, as we talked about before, consumption continues to grow in the Chinese economy, and especially that rebalance that we've seen over the last 10 years as it kind of rotates away from a more kind of export or industrial type economy to one that starts to look a little more similar to the US, which is much more consumer heavy. And as we look to, that EM equity view, you can see over the last 10 years on a kind of sector basis of what we've seen in the emerging market, equity index, fairly substantive changes, and this is reflective of, the changes in that kind of consumer and economic rebalance that I just mentioned, where we're seeing kind of greater exposure to technology relative to 10 years ago, or, consumer discretionary and consumer, focused companies. And you also see it on the other side, where financials come down, energy sector have come down, materials have come down, which really reflects that economic rebalance and also where we're likely to see continued gains to come from these markets on a go-forward basis. I think what's also important is, what's just as important as kind of overweighting or kind of having positions in emerging markets, it's how you implement. And we'd encourage, having kind of high conviction active management names in the emerging market space. And this applies both to the large cap and small cap space, but the use of higher tracking year managers to maybe take up a greater share of your portfolio tracking year budget, we think will pay dividends down the line, as active management can really benefit in the emerging market space. One other kind of important point that we wanted to discuss is, over the last year, we've seen a lot of distress in energy prices, and this translates into the kind of the public market real asset space, where you can see the 1-year returns for global natural resources and kind of midstream energy, pretty significant price changes over the last 12 months. And we think this is reflective of moving out of 12 months ago, which was clearly a distressed time period, to we're seeing prices more normalized. And that normalized price trend, I think, is a good opportunity for folks that don't have a strategic allocation to real assets to evaluate, what positions do I have today, and does this fit my portfolio objectives? Can a more tactical or thematic view of midstream be redeployed into other areas of the portfolio? That said, if you do have a strategic allocation for real assets that's dedicated to providing some level of inflation sensitivity for the portfolio, I think it's also a good time to take a look, reevaluate. Is this providing the beta exposure I need in terms of the type of inflation sensitivity that it might flow through? And last, we'll end with, before I toss it to Oliver, we'll end with a quick overview of kind of what we're seeing in credit spreads, especially for the public credit space. When we look to high yield, we've seen some pretty significant changes over the last 12 months. When we chatted last April, spreads were elevated. We're looking at kind of more opportunities both in the equity complex and the credit complex, and we've seen pretty significant declines in spreads over that time, to the point where high yield spreads are starting to approach the lows of the last 20 years, and we're also seeing triple C spreads really touch cyclical lows, which is telling us that credit markets don't have a lot of fear right now. They're not concerned about economic activity and defaults. And I think the one thing that we want to emphasize is, as these spread levels continue to grind lower, there's only so far that credit spreads can fall in some ways. And you start to end up with a more asymmetric return profile where there's only one direction for spreads to go, and that's up. We're not there yet, but something to keep in mind. And I think as we think about kind of the outlook for the economy and kind of risk assets, thinking about equities potentially being more attractive than public credit or kind of return-seeking public credit, considering kind of the relative spread levels we're seeing today. That said, that is very much a comment on public credit, and Oliver is going to walk through some thoughts and provide an overview of kind of NEPC's view of the private debt markets for you all now.
Thanks, Phil. My name is Oliver Fadley. I'm a senior research consultant on the private markets team covering private debt, and I'm going to give a quick overview and talk about some of the things that we've been doing here at NEPC. So looking at this first chart, there's no question that private debt has grown as an asset class over the past few years. Even with COVID, technically fundraising was down 10% year over year, but that translated into still $118 billion being raised within the various asset classes. And that translated into about a 5% rise in assets under management, which was the most of any asset class last year. And it's expected that private debt AUM is going to reach somewhere along the lines of 1.4 trillion by 2025. And so, as the asset class has grown, competition has increased. Returns have definitely compressed a little bit and trended downwards, but remain attractive relative to some of the other fixed income markets. We see that investors are still seeking out those key tenets, whether it's diversification, lower correlation to other asset classes, or reliable income streams. Preqin just did a study, and 47% of investors polled expect to commit more capital over the next 12 months, and another 40% are intending to maintain those investment levels. And so, at NEPC, we try to be forward-thinking and identify areas that are less trafficked or overlooked. This is something that we've always done. We've been doing this. I would argue that we've been doing this since the beginning. We have resources committed to the space, and they've grown with the evolution of the asset class. And it's a big emphasis. It has been a big emphasis, and it will be even bigger emphasis going forward as we keep an eye on kind of the evolution of the asset class. But to talk to the market a little bit, the stress cycle didn't quite materialize the way we thought it would, and so this next slide, I'm going to highlight on how we position our thinking and what we've been looking at. So as I just said, with the opportunity and the Fed stepping in the way that Phil was that Phil said, the opportunity really didn't last as long as we thought it would in kind of that true sort of distress cycle. But what you did see was $69 billion of assets being raised by distressed strategies. So there's no question that it's definitely a crowded house. So I think when we sat there and we've been thinking about it, is if there isn't this massive beta opportunity, where do we go? Like, what should we be looking at? And I think the big thing, what we've done is we've really looked down market. We've been looking at smaller companies, so small to mid cap companies that haven't benefited entirely from the fiscal stimulus. There are still opportunities to be found here, and this tends to skew to smaller funds as well. But if you go back and look at 2008, what was really kind of driving some of the recovery there was primarily telecoms, consumer, and energy, with the rest lagging. This time around, it's a lot more of an evenly distributed and tech-heavy sort of opportunity set. But the sectors that we have been looking at and that have shown some recovery are things like consumer staples, logistics and distribution, online learning, and then of course healthcare services and tech are ones that obviously have gained a lot of traction as well. But overall, it is becoming harder and harder to sort of find those diamonds in the rough. Based on sort of how fast the economy has come back. The other thing, as we look at sort of that more opportunistic credit spaces, we are looking at some of the kind of macro growth tailwinds. And so some of these strategies that we are looking at are credit strategies with some equity upside. This is primarily within kind of certain tech subsectors or areas of healthcare like life sciences, but ones that we feel where if in terms of the macro, if there is going to be a little bit of growth for the next couple of years, how can we participate that even though we are in primarily credit strategy? And so another area that we're looking at are kind of these structured capital, but where you can either move down the capital stack or obtain some of that equity, whether it's through common or pref. But obviously, investors should be, anytime you're kind of moving up and down the capital stack, you should be wary. And the big one obviously being is credit selection and active management. I think where two areas that we do think are interesting, but there is sort of more of an emphasis on active management is the deleveraging theme in Europe. It still hasn't quite materialized and become a beta play, but you're starting to see some indicators. And then what Phil alluded to, where even on the credit side, there are some managers that can move in between some of these deleveraging and capital solutions themes, including some of these deals that do have equity upside and tapping into some of the consumer themes that Phil mentioned earlier. But as a firm, I would say, where we look to add value is also not just manager research, but there are other areas that we think that we can add value and benefit some of our clients. So Phil, if you don't mind moving to this last slide here. One of the things that have been a huge focus that we talked about at our offsite earlier this year was really the focus on implementation and creating and trying to create solutions, because obviously investors are very different and have different needs. So we've been really working with clients around constructing portfolios based on specific characteristics. Some examples being income versus capital appreciation, relative value across the entire fixed income spectrum, so public and private. And we've been working with other with our private fixed income, or our public, fixed income group as well. And then as well as looking at sort of the leverage and stress testing within clients' portfolios. I think that's one where it gets overlooked sometimes in terms of how resilient can a portfolio be, and that's where an area that we've been spending a lot more time on. And so we've also been working with specific practice groups to address their different client bases. So we've been doing market maps, for example, for managers that are RISA or QPAMs, because not every manager is willing to do that. We've been doing that with some of our Taft-Hartley discretionary clients. We've also been working with our insurance group to do a market map of rated note vehicles, as well as a big emphasis on our market maps for diverse managers. We've been spending more time working with managers with a emphasis on fees. It's one where we've done a pretty good job making some headway. But it's the point is that, with a time like this and as competitive as it is, it's really important not only to be finding good ideas and conducting deeper diligence, because things have definitely come back and are definitely competitive, but also focus on the implementation side where not only are you finding good ideas, but you're making sure they're getting into portfolios and they're really sort of maximizing that value. So I'll end that with that, and I'll hand it back to Phil for questions, but I'm happy to answer anything in the Q&A. Thank you.
Great, thank you, Oliver. First, but before we turn to questions, just want to have a quick commercial for our NEPC conference that will be coming up. It's a virtual conference, obviously with unique conditions that we're living in, but it's scheduled for May 4th and May 5th. We think we have a great set of speakers and topics lined up that we're really excited about. We even packed in a kind of virtual network session, for the attendees, which we think is going to be a really interesting way for all of our clients to interact. And I think we've jammed kind of a lot of content into what will be a very efficient use of your time. So we really hope all of you will be able to join us. And just as a reminder, the last day for sign up is April 30th, excuse me. And please reach out to your NEPC contact. If you have, would like to attend and join, and I think we'd be more than happy to have you all. So maybe first, kind of a question, directed to myself, from the audience, and then we'll send a question to Oliver. In relation to our thoughts on kind of an underweight public credit position, especially specific to high yield. How does one implement that, and what does that kind of mean in the context of a broader portfolio, was the question that came through, which I think is a really good question to ask, because as we think about spreads kind of continually to grind lower in, let's say, high yield, is there a better risk return profile in return that we might see out of equities? So some of the things we've been thinking about and talking with some folks about is reducing that high yield position a bit, deploying a little capital into equities, to be a slight overweight there, but also using some of that capital to kind of firm up that kind of safe haven fixed income profile. So you get a bit of a barbelled risk profile with an adjustment along those lines. And maybe in relation to kind of private debt, a question for you, Oliver. Based on how competitive the market remains, especially in the private market space, are we doing anything different in terms of how we diligence managers or how we look at opportunities?
Thanks, Phil. Yeah, it's a good question. I think there are definitely there were some adjustments that had to be made, like everyone had to do last year, in terms of being stuck inside your house, and so we did have to pivot. And there are some things that we are definitely doing differently, especially trying to take advantage of some of the efficiencies that we're sort of that are available to us because of COVID. I think some of the things that we've been looking at, there's definitely a bigger emphasis on the diligence process, and one is just manager transparency. I think it's one that it's important, but one that has definitely become more important due to COVID, and one that I think it's sort of a true test of kind of the relationships that you do have, and what managers are willing to sort of open up about during this, especially during a time like this. But it's one that I think we've basically stepped it up a notch in terms of really harping on manager transparency. And I think the other things that we've done too, to be a little bit more specific, is we're definitely doing more what we call mini on-sites. So typically with on-sites on the private market side, you'd have kind of one big one, but through Zoom, we've been doing kind of 2 or 3 where they're a little bit shorter. You have access to more people. You can take a little bit longer because there is no travel. And then on top of that is we're doing a lot more reference calls. I think that's something that's really important, and really, without being able to meet some folks, really drilling down and trying to triangulate and get as much information that you can, especially those that are kind of off the page and sort of back channel into things that you're trying to figure out. But the other thing that has, as we look at some more kind of private market strategies, is really the focus on the illiquidity premium and the relative kind of opportunity costs. And I alluded to it earlier. when I said we were working in tandem a lot more with our public fixed income teams, because as the market has become more competitive in the private debt space, I think that's one where the lines get blurred in terms of, what are we really giving up and what are we gaining, and is that illiquidity premium shrinking, and then on top of that, sort of how can we implement it? So, if there is an area that we can access in a more liquid vehicle, more on the public side, why don't we do something like that? And so I think that's probably in terms of things that we're doing a little bit more and focusing on, that's kind of what comes to mind.
Great, thanks Oliver. And for our last question that we have, coming in, focused more on kind of a LDI kind of investment area, which is a really good one considering, we saw a pretty significant movement in interest rates this last quarter. So, there should be kind of a much closer look at kind of glide paths and how, portfolios have changed over the course of the last quarter. But the question that came in is, considering our favorable view of equities, should we consider, slowing down kind of the shift out of equities as opposed to, following maybe kind of the glide path and the trigger points that we've seen. And I think what we'd say is kind of, this is very much kind of the house view, is, the glide path trigger points are really designed to be, a strategic, governance document to ensure that, we're maintaining our risk relative to funded status. So our bias has always been, if you, reach or kind of hit the trigger point, to make the adjustments that have been prescribed into the next glide path point. And if that involves bringing down some equity exposure and adding duration, that's something we're very much supportive of. And I think really the focus that we have in this space is less on, let's say, aggregate equity exposure, kind of portfolio risk level, but it's really focusing on, what is the, and for the LDI clients, they'll be very familiar with this concept, what is that surplus vol? And as funded status improves, that surplus vol should start coming down for the portfolio. So that's the focus point. But if like all things, there may be some unique situations that come up. But considering the big move in interest rates, I'd encourage everyone with a glide path, just to take a look is, when you have 80, 90 basis point moves in interest rates, I think that's kind of sound governance. So that's all the questions we have for today. I want to thank everybody for joining us. Just a couple items for everyone. Our slides, if you want to have the slides and the recording of this session, will be posted on our website, and so you'll be able to find them there. And in addition, if you have additional questions on our kind of private debt capabilities or thoughts on implementation in this space, please don't hesitate to reach out. We're doing a lot of work with clients in that space today. And on the last note, I'll end with the last plug for our client conference. As I mentioned, we're really excited about this. It's hopefully going to be the one and only virtual client conference we ever have. But we're very excited about it, and that'll be on May 4th and May 5th. So again, if you're interested in attending, please reach out to your NEPC contact, and the deadline is April 30th for registration. So thank you all for joining. Enjoy the remainder of your day, and if you do have any questions, feel free to reach out. Thank you all.